Hello Sector Watchers, welcome to the show. This is the 204th episode of Sector Spotlight for Monday the 22nd of January 2024. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. We're going to have a look at quick look at asset allocation, quick look at what's happening in sector rotation, and then I want to take a look at how the US is positioned internationally, so comparing the US stock market to other world country indices. Ladies and gentlemen, this is Sector Spotlight. Let's start with a quick look at the further progress of asset class rotation. The trends that we discussed last week are merely continuing. I've got the weekly RRG on the left, daily on the right. Let's quickly get Bitcoin out of the way, because it was already losing at least relative momentum for some time, and you can see that loss is now accelerating. If we look at the price chart in a minute, you will see that the outlook for Bitcoin, at least for the near term, is getting a little bit tricky. I think the longer term trends are definitely still there, but for the near term, there are a few levels that we need to take into account. So from a relative perspective versus VBINX, Bitcoin is still way on the right, but it's rapidly losing relative strength and relative momentum. So be careful, at least in the next, I'm going to say few weeks, I guess. That's the time frame that we're talking about. So I'm going to take it away here, and I'm going to take Bitcoin away here. And the picture that we are left with is actually quite striking. If you remember last week, the one asset class that was kind of in doubt whether it was going into the leading quadrant was corporate bonds. And you can see how that was like just right here last week. But if you look at the daily, you can see how that turn is now starting to take shape. And that's very likely going to cause that weekly tail to not hit the leading quadrant and move back towards lagging. And that makes for a very clear picture in favor of stocks. If you look at SPY, that's the only one at a positive heading between 0 and 90 degrees, and all others are in the lagging quadrant or almost in the lagging quadrant, while SPY is moving into leading. If I really zoom this out, so this is your weekly RRG, you can see how that tail has moved into the leading quadrant. And corporate bonds, LQD, you can see that last tick, this is today's price action, is actually moving that tail further towards the lagging quadrant. Now, if you look on the daily, we got a little bit more price action here, and you can see how they are all rolling over, high yields rolling over, government's now pushing into the lagging quadrant, LQD is pushing into the lagging quadrant, and SPY is firing off into the leading quadrant. So a very clear picture in favor of SPY. Now, the only one that is a little bit of a curveball here is the US dollar. If you look at the US dollar on a daily scale, you can see how it was improving and it's losing a bit of relative strength. And here you find the US dollar right here, deep into the lagging quadrant. Now, the thing is that this is on a relative basis versus VBINX and the other asset classes. If we take a look at the price chart of the US dollar, and especially against the euro, I think there are some signs that the US dollar is picking up some strength again. The problem is that it is not strong enough yet, I probably should say, to turn those tails around. But we're going to take a look at that chart in a minute. Let's start with the price chart for Bitcoin. And if you look at the weekly chart here, you can see how it ran into resistance around that 48,000 peak that was set back in March of 2022. We pushed back and we're now playing around in this support zone, which is around the 40K level. And we really need to go to the daily version of the Bitcoin chart to see what's going on. And you can see how that 40K level has been working as support 1, 2, 3, 4 times already, and it's right in that area as we speak. The first support level, if that 40K gives way, I think is going to be around 38,000. That's the area where these highs are clustered. That's end of last year. And then if things really deteriorate and there is a further setback of Bitcoin in store, I think that the ultimate target would be 31,000, but it's questionable whether we're going to get there. The longer term outlook for Bitcoin, in my opinion, remains pretty strong, because I think that we finished this bottom formation here. We're on the way up. We're now, we ran into resistance around 48,000, and we're in some sort of a correction or a pause. And the question is whether this digestion of that previous rally is going to take place, let's say, above the 40K support area, maybe between 40 and 47.5, or we need more corrective moves, and then it could be going down to 31, 32K. But if you just, eyeball this trend, I could imagine that if a new low comes in, that it's going to be lining up with the previous major lows here. This is, at the moment, this is just a random line, but if you've got some sort of regularity in a trend following, then we could see some low getting in here around 32.5, and you could see a new trend building. It's too early to kind of call for that trend right now, but the rhythm of higher highs and higher lows is certainly still there. It has gone through a massive rally versus all other asset classes, so I'm not too worried about the digestion, the pause in the rally as it is right now. The only question that I have is whether it will be able to digest all these gains above 40K, or do we need more of a setback before new buying opportunities will arise in Bitcoin and maybe cryptocurrencies in general. I promised you the chart of the US dollar, so let's take a look at the dollar index. You can see how that nicely bounced off that broad trading range that is in place since the start of 2023, basically, so a little over a year. It looks promising from that perspective, but if you zoom in and look at the euro-dollar chart, then I think things are going to get a little bit more clarity. You can see how we broke below this rising support line, but what I've actually been watching is the formation here of what I think is a bearish flag pattern in the euro-dollar price chart. And if I just apply some classic technical rules, we got 111.40 right here. The low of this pattern is 109, so that is a good 2.3 cents. And then here's got a very nice tight flag, 2 to 3 weeks. That's what Edwards and McGee describe as, on a daily chart, what a good flag pattern should look like. And it's almost all filled. You can see that all these bars, the high and lows, the bars are all overlapping into that nice flag pattern. And then last week we got this solid rapid breakout, leaving the flag, but at the same time pushing below that rising support line. We're now consolidating and going back up, but still that former support line now acting as resistance. But from this flag pattern we can project 2 to 2.4 cents downward, and this is 109.45, and that gives us an area around 107, 107.3, and it's exactly this area here where the low of December, the high of October, and this hesitation here in November are lining up. So if this continues and we don't all of a sudden break back into that channel, and that flag pattern holds, I think that the target area for euro dollar is around 107, 107.40. So that's quite a big move for euro dollar. And if you look at the weekly chart, you'll see that that is happening as well. You can see that big range here and getting out of that trend channel, and how there is the RSI is absolutely neutral. There's no overbought, no oversold, there's no divergence. So there's all the room for euro dollar to actually move lower. Now let's look at the chart of SPY. the asset class that is actually doing really, really well. You can see how it's breaking out of the range on the daily chart. So that was last Friday was a very good follow through for the stock market, and this is just an outright bullish signal for stocks. I can't read it any other way at the moment. Of course, we need to wait what's going to happen in the next few weeks, but for now, I'm going to take this as a pretty strong signal. What you can see here is that on the weekly, we're actually also breaking above that already rising trend line. So that is confirming the bullishness that we are seeing right now. It's going to be interesting to see how this week is going to end. I would love to see SPY to hold up above these breakout levels to really confirm it. If that doesn't work, if we somehow drop back below that former resistance, now support, if we drop back within that trend channel that you see on the weekly, we probably need to revise or reassess what's going on. But for now, the break is there, it's holding up so far, and things look good. It's a good trading opportunity because your stop losses can go actually relatively close. We know when things are going wrong. But again, if you think back about the RRGs, that both on the daily and the weekly, those tails are ready to move further into the leading quadrant. So just from an objective point of view, just putting all the pieces of the puzzle together, I think that stocks are in good shape. Or maybe the other way is true, that all other asset classes are in bad shape. So we'll have to see how that one's out. But for now, I think things are looking pretty good for SPY, for the S&P 500, for the stock market in general. Moving to sector rotation, we see an ongoing rotation as it was going on last week, especially on the weekly. Not too much changed here. But if you look at the daily, that's where some big moves are visible. And they're interesting. Because if you wonder what drove the market higher last week, then this chart will give you the answer. Because there's only one tail that is moving into that 0 to 90 degree heading, that positive RRG heading, into the leading quadrant, and that is the technology sector. That's XLK. Look at this move here. 5 days ago, it was inside lagging, picking up, and within the span of a week, we moved through improving right into leading where we still are. So this includes today's price action. So that's the stronghold of the US market right now. That rally was based on the technology rally. That is okay, but it's not like very broad-based. The other area where strength is visible is in communication services. You see how this tail here is inside leading. It's losing relative momentum, but combine or look at the differences between this tail here and this tail here. They cover the same amount of trading sessions, 5 trading days. This is a really long and strong tail, and this is very short, and all the observations are very close together, which indicates that not a lot has happened. And you can see that on the weekly. You can see it back on the weekly. So here you see technology still strong inside leading. We lost a little bit of momentum, but it's picking it up on the daily. And if you scroll this one back, you see that it starts to move to the right again, albeit a little bit. But just based on the RS ratio, technology is the strongest sector in the US at the moment. If you look at the communication services tail, you see it's inside weakening. It leveled off on the momentum scale, and it started to slowly pick up, and you can see how it's picking up right here. So the combination of those tails, the weekly and the daily, indicate that there is still some strength left for technology and communication services. If you look at the other tails here, then I think the one that catches the eye is healthcare. It's one of the defensive sectors, and I'm going to go into that in a minute, but it's rapidly losing relative momentum and start to head back to the lagging quadrant. And inside lagging, you see consumer discretionary and industrials picking up, albeit only a little bit, and they're still moving to the left on the RS ratio scale. If we go to the weekly for the longer term trends, then I think the interaction between the daily and the weekly for the defensive sectors is interesting to watch for this week. Because we know that when money is moving out of the defensive sectors, that's usually a good thing for the market as a whole. So with the other tails, with the other sectors a little bit conflicting and scattered all over the place, the tails of the defensive sectors are now starting to move in sync again. Look at utilities. It is rotating back into the lagging quadrant. And if we bring up utilities here on the daily, you can see the same. So utilities are now clearly back into underperformance territory, in negative territory, and they're further heading into that area. The same goes for consumer staples. You can see how staples is rolling over and about to hit back into the lagging quadrant on the weekly. And if you look on the daily scale, you can see how that tail, it starts right here. Maybe it's a little bit hard to see. You can see how that tail right here is now moving into the about to cross over into the lagging quadrant. So consumer staples also back on an underperformance trajectory. It's back into negative territory. And then we've got healthcare, which is still on a pretty strong rotation on the weekly scale, just coming out of lagging, crossing over into improving. But if we look at the daily, it's rotating back down. So if this, and this is, it's not the shortest tail on the plot, but it's not a very strong tail either. And here you can see how this is quite a long tail starting to push further down. So if this rotation continues, then it could very well be that it's going to drag that healthcare tail back down. So nevertheless, 2 out of 3 are in sync, and healthcare is at least on the daily starting to move there. So out of these defensive sectors, money is moving out of these defensive sectors. At the moment, it's going into technology and to a lesser extent communication services, but it's pretty clear that the market is leaving its defensive position, so to say, if it was there. But right now, it's definitely going out of there. The money's rotating out of these defensive sectors. It's going into technology, into communication services, and it looks like it's picking up on consumer discretionary and industrials, but that's a very, very early call. Let's take a look at some of the individual charts. Starting with the technology chart, and it's very clear. We already had that rising relative trend. We had a very good high-low rotation, testing that former breakout level that acted as support, and now to a new high in terms of relative strength. And a similar pattern is visible on the price chart. We had the breakout here, rally, a little bit of a pause, and then this was last week, and we're starting with a good follow through this week. So technology sector seems to be in good shape. The little loss of momentum that we're seeing here is because of this sideways move, so I expect that to catch up relatively soon. If we look at the other sector that's doing relatively well, that is communication services. Let's bring that right up, and you can see how that is still working its way higher inside the boundaries of that trend channel. We're on the way to 77.5 for XLC, and you can see how the trend in relative strength is holding up. We put in a new higher low, which is the good news, and it looks as if we're ready to pick up some momentum again. Now, as I said when I talked about the RRG and the rotation of the defensive sectors, those are the charts that I want to talk about. So that is utilities, staples, and healthcare. And let's start with utilities. What you can see here is a very clear break of the trend that we had since October, and we didn't make it beyond that falling resistance line. The high came in here, and now we break the trend line and we break the previous low. So that is a very clear confirmation of the end of whatever uptrend there was since October. That is now reversed, and we're now back in a downtrend for the utility sector, and that's reflected in that raw relative strength line, which is continuing to make new lows and still under the pressure of that falling resistance line. So clearly money moving out of the utility sector. Let's take a look at the consumer staples sector, and we see quite a similar picture. It is a very stable uptrend. Look at how all these weekly bars are overlapping. It's like almost a solid block of bars, and we now break that rising support line. We break the previous low in relative strength, and the RS ratio was still very low, and it's now starting to lose relative momentum again. So there's also very clearly money moving out of the consumer staples sector. It's still within that longer trading range, but look at the width of that range. So even if it goes to the lower part of that range, that is, you know, from over 71, almost 72 US dollars to around 64, 65 US dollars. That's about a 10% drop. That's a very serious drop. The last defensive sector is healthcare, as you know, and the picture here is slightly different, but not super strong, because here you can see how healthcare is pushing against its all-time highs, against that overhead resistance. The peaks that were formed in April 2022, and then again at the end of 2022, are now in play as resistance. We peaked above it a couple of weeks ago, but we never really made that push and solidly went over that resistance area, and it's reflected in a relative strength line that didn't make that complete turnaround. It's still possible, but it's not as good as other sectors. So from that point of view, 2 out of 3 defensive sectors are signaling money moving out of defense, going somewhere else in the market, and healthcare is only doing that on a very near-term basis, and we've got to wait and see if that also spills over to the longer-term trend for healthcare. All in all, the current sector rotation is definitely in favor of technology and communication services, and money is very clearly moving out of the defensive sectors, and all of that underscores the current strength for the stock market. And finally, let's take a look at how the US is positioned versus other stock markets around the world. We've got the RRGs on the screen, and on the weekly, let's pick out the S&P. So S&P is right here. It's a very short tail, but if you watch closely, you can see how it rotated from leading through weakening, and now it's started to head back up towards leading again. So that is a strong rotation. That is a good rotation. If we look at the other markets around the world, then you can see that the majority is moving away from the US. It's moving away from the US, and it's moving away from the benchmark, which is the Dow Jones Global Index. And obviously not all those markets are equally important, but a few that I want to pick out because they're big markets and because they have interesting tails, so to say. And the first one is the Hang Seng Index. This is China, not very good either, but the Hang Seng Index is at a very strong negative trajectory. Money moving out of that, so money moving out of Hong Kong and China together. This is Russia, by the way, so maybe we should just take that away. I don't think a lot of people are particularly interested in investing in Russia at the moment. On the opposite side of the Hang Seng and China, I think we can find the Japanese Nikkei index. Look at that tail. It's moving, starting to move at the opposite side, moving away from it. And that's very interesting. So in the Asia Pacific area, in that region, I think there's a pretty clear preference for Japan over Hong Kong and China. If you look at that on the daily, you can find that the Chinese tail and the Hang Seng tail are in sync with what's happening on the weekly, and so is the Nikkei. The Nikkei is actually deep inside the leading quadrant already, so it's pushing ahead, dragging that weekly tail higher. So for that respect, prefer Japan over China and Hong Kong. Let me get the RTSI out of the way here as well. Now, for the US market, I showed you the weekly tail, but look at the daily tail for the S&P. That is making a very strong rotation back into the leading quadrant. We had that short rotation, and look at how the S&P remains very close to the benchmark. There is a reason for that, because the S&P is the biggest component inside the Dow Jones Global, so it will always be very close to the benchmark. So the direction of this tail becomes even more important. And what you see now is that it is pushing again into that leading quadrant again, leaving the other markets behind. So the S&P is outperforming the Dow Jones Global, but it's also outperforming the majorities of all these other countries on the plot. Now the other one that is interesting to watch and to keep an eye on is the India market, so the Nifty 500. You can see how it's going through a bit of a setback here on the daily, but on the weekly it's actually coming back up. So that is a market that I would keep an eye on as potentially catching up with the S&P 500. There's one big caveat, and that is that the Nifty has already rallied very, very strongly. So the question is whether it'll be able to sustain that that pace, that angle of attack there. If we look at a few of the individual, the last one, most important one, is the comparison between the US and Europe, and it's best visible on the weekly. We already saw the tail of the S&P bending back up and starting to move towards leading, but look at what's happening with the Dow Jones Europe Index. It's shaving off that 100 level on the odds ratio scale and now starting to back down lower towards the lagging quadrant. So this signals a very clear preference for US stocks over European stocks on this weekly time scale, and do it again here on the daily, and you will see an even more pronounced preference for the US. So this is the Dow Jones Europe Index pushing deeper into the lagging quadrant, and here is your S&P moving away. So the spread is going bigger, and that very clearly indicates a preference for US stocks over European stocks. Let's take a look at a few of these individual markets. I already had the Dow Jones Europe ready here. You can see how that is failed to break to new highs. We could just a marginally higher high, and then it started to roll over. So we're moving lower, and that's reflected in that relative strength line. So that's the preference for the US over Europe. And let's bring in the other combination that we talked about, and that was Nikkei versus Hang Seng. So here's the Hang Seng, and look how that is shaving down. It's coming at a very important level. So the Hang Seng is now coming very close to its 2022 low, around 14,600. The relative strength line is very clear. That is pointing lower. So we could get a little bit of a hiccup here if that support level holds, but this is a very weak chart. So just please be aware of that. And if we compare that to the Japanese Nikkei index, that is a completely different picture, where the market is breaking higher. We had this consolidation pattern, could label it as a head and shoulders continuation. But I think you will agree with me when I say that this has been a very steep rise, and I wouldn't be buying into that rally. I mean, the chart is undeniably very strong, but I'd be much more interested to buy this market when it comes back to, in an ideal world, testing this former resistance as support. But maybe the demand is so strong that we will never get there. But chasing this market higher is probably not a good idea. So we need to wait and see if it comes down and we get a better opportunity. And with that said, a similar thing can be seen in the Hang Seng. So if you're a really short-term trader, you could be looking for a bottom in the Hang Seng and a peak in the Nikkei to offset that trade in a pair trade, or wait until they continue their relative moves, preferring Japan over the Hang Seng. It just depends a little bit on what your time horizon is, but the big moves in those markets give you very good trading opportunities, either for a short-term stint, short-term trade, or waiting for a little setback in both markets and then putting on the trade that is going on Japan over Hong Kong. Same with the S&P and Europe. I think that is very viable right now. Very clearly prefer the S&P over Europe. And if we finally wrap it up with a look at the Nifty index in India, same story here, where the market has rallied tremendously. Relative strength obviously very strong, RRG lines very strong, but you are chasing a market higher, and it looks as if we're into some sort of a reversal pattern here that's starting to set up this week. So I'd be very careful with chasing India higher. So the big moves, US over Europe, Nikkei over Hong Kong, and in general the US leading the rest of the world. And that wraps up Sector Spotlight for this week. Thank you for watching. I hope you enjoyed the show, and please remember, Sector Spotlight is available on demand on the Stock Charts YouTube channel, usually recorded and uploaded on Mondays. Feel free to share your thoughts and ideas in the comments below the video. We read them and we try to respond to them. Looking forward to seeing you again at a new episode of Sector Spotlight next week, same time, same place.